but it all has consequences, and I think we are starting to see the consequences of.
A storm is building in the American real estate market, according to veteran investment sage Warren Buffett. The real estate industry is being overtaken by a massive tsunami of $1.4 trillion in debt. Buffett, though, believes that this is really a prologue, a mere whisper of the upheaval that is likely to break out in the upcoming months. The echoes of Charlie Munger's warning is the first chapter of Buffett's oracle. Buffett addressed Charlie Munger's somber warning about a potential storm in the U.S. commercial real estate market in an interview. Munger, Buffett's longtime business partner, stressed the ubiquity of risky loans in American banks, particularly as property values start to decline. Due to tax reasons, Berkshire Hathaway has typically steered out of commercial real estate, but Munger provided a vivid picture of a shift looming over downtown regions, both domestically and internationally. He made the argument that although the building's exteriors might be defiant, ownership might change. Point number 2. Symphony of Debt, the 15-year overture. A deluge of low-cost loans has been orchestrating the U.S. real estate market's 15-year symphony of prosperity. The graph showing the federal funds effective rate, which hovered around zero for the majority of this time, graphically depicts this crescendo. The conductor's baton of these record-low borrowing rates led borrowers to a symphony of unheard-of heights in real estate prices. Point number 3. Leverage, the art of real estate financing. Think about the hypothetical scenario when someone decides to spend $1 million on an office building. Instead of carrying a bag packed to the brim with cash, one daring explorer choreographs a dance with a bank, receiving a loan while putting up some money as equity. The loan's interest rate determines whether or not this acquisition will even be profitable. The annual payment to the bank, on the assumption of a 5% interest-only loan, is a magnificent $32,500. The ability of the property to meet this debt payment depends on its net operating income, which is created by deducting related expenses from rental income. Point number 4. Debt service coverage ratio, the conductor's baton. The debt service coverage ratio, or DSCR, is the maestro's yardstick. This masterful measure waltzes in to evaluate a property's ability to fulfill its debt obligations. The virtuoso benefits from a DSCR higher than 1.2. With a 5% interest rate and a $60,000 annual income in this area, the property gracefully pirouettes over this bar. Point number 5. The fickle winds of change, rising interest rates. However, interest rates are not constant for the big symphonies of commercial real estate. Rather, they pirouette and reset every few years. The unpredictable choreography could put property owners under financial strain. The symphony's crescendo heightens when interest rates rise, possibly jeopardizing the property's financial sonata. If the property's income declines, this is made worse, and the present push towards remote labor makes it much worse. Point number 6. The sirens of non-recourse loans, a foreshadowing of foreclosure. Buffett breaks down the concept of non-recourse loans, which are frequently used in real estate and allow borrowers to walk away from their debts free of personal liability. When rates start to rise, this siren's melody encourages reckless borrowing, which results in a dangerous symphony. With these loans, commercial real estate holdings that were bought at the peak of the market could now face a funeral dirge, leaving banks with depreciated assets. Point number 7. The wider ripple. These defaults have effects that extend far beyond the real estate market. The local symphonies of tiny regional banks provide the crucial overture in commercial real estate loans, as opposed to the enormous concert halls of giant banks, which reverberate across the financial industry. With their lending to small and medium-sized firms, these institutions create a sonnet whose refrain propels regional economies. Reduced access to credit for these businesses due to the ripple effects of these losses might potentially halt the crescendo of economic expansion. The final, a symphony unfolding. In conclusion, Warren Buffett's warning illustrates the shaky equilibrium in the American real estate market, which is influenced by a rise in debt. As interest rates rise, non-recourse loan finance houses may be forced into foreclosure, casting a shadow over the real estate market and the larger economy. Although the full scope of this approaching symphony is yet unknown, its effects are likely to be felt throughout the corridors of business and finance. This is meant to be a forewarning to investors and stakeholders to proceed with prudence and to prepare for the potential crescendos and diminuendos that lie ahead in the real estate symphony.